And the world gone insane with Sniffy Joe at the helm and everybody getting a new tattoo of the Ukrainian flag and everyone saying, what happened to the mandates? And the world gone in crazy. There is a breath of fresh air, the light, called U.S. Financial Accounts, U.S. Household Wealth by my man Ed Yardeni. 516, that means it's a Long Island area code. Yeah, Long Island, right? I think so. Yeah, Long Island, 516. Anyway, my friends, there's a lot of stuff to be negative about. I get it. Lots of stuff. But, jeez Louise, blue cheese. Can we put things in perspective? Please, for the love of all. So let's check this out. Big fan of Ed. Did he write this book? Easterling, who had wrote, I got a couple books on Easterling back there, who's since passed, if memory serves. Anyway, big fan of Ed Yardeni over at Yardeni Research. Anyway, I just want to show you something here, man. This is, look, Dateline December 20th, 10th of 2021. Net worth, assets, liabilities, IRAs. I just love this stuff. It's a very simple to read chart. Net worth, this is the net worth of the Q3 2021 of the U.S. households. $150 trillion. And that's ratio scale. All right, so if you look, look at that, $150 trillion net worth. What's net worth? Assets minus liability. As a percentage of disposable personal income, the highest has been essentially ever at the end of Q3 21, excuse me. As a ratio of percentage of disposable income. Crazy. Net worth. U.S. trillions of dollars ratio scale. Net worth, assets and liabilities. Liabilities are right here. Assets are right there. You can say, well, that's because of Bezos. Bezos' net worth might be $200 billion. Elon Musk might be $200 billion, but it ain't $144 trillion, man. It's not. U.S. household net worth. The total assets are 162. The liabilities are 18 trillion. That's not that big of a deal. I'm just sorry, it's not. Assholes and liabilities, I don't like the percentage so much. U.S. households financial assets 114 trillion, non-financial 48, and then we're gonna go to house. Actually, I want to go down to your equity. I want to go to right here where they got your corporate owner's equity and household real estate. $25 trillion in real estate assets. So if you took the entire debt of the United States consumer, which is what we say, 18 trillion, you still have 7 trillion left just in your equity in your home. Equity and owners and household real estate. That's just your home, not including your investment assets or in terms of your rentals, if anything like that. Now you can see the big jump up here was right there, equities. That's of course because the last couple of years just went crazy. Here's pension entitlements. Well, you should get that, but all I care about is right there: equity in households and corporate equities. Look at that, mutual funds, 12 trillion, corporate equities, 30 trillion, owners' equity and household assets, 25. Because the reason I care mostly about real estate is because you can see right here. Here's a 2008 collapse, and then it came back up. So if you have a linear, it's like spot on to where the linear thing. We had a little bit of a bubble, we had a bear, and right back on. This right here, that's a corporate equities. That's not linear. That's a bad sign. There is going to be a pretty significant fall at some point in corporate equities. You have that big of a run up. That's impossible. All right, so let's keep going here. Percentage of assets: 17.5% of people's assets are their equity in their home. That's just crazy, man. And typically that's the most. Now, pension fund reserves, you can't really consider that U.S. households. But anyway, I want to show you something else. Liabilities. Look at that. Home mortgage debt pretty much has leveled off since 2006. What was that? 10 to 12 trillion dollars. 11, I think, is what it said here. Of debt was right. I think it was 11. Yeah, 18 trillion dollars of total liabilities, of which household debt was about 11 trillion of household debt. That's it. And yet your home equity was what, 25 trillion. So you got more than 2 for 1. I mean, look at that. Total amount of mortgage debt has been leveled off. And yet you're going to say there's a bubble? Not a bubble in real estate. So here's the dollars, the bubble right there in stocks. Not a bubble in real estate. That's, I mean, that red's real estate. If you look, if you just did the just like that's right where it should be from 1990. It's the stocks that are not a bubble. I mean, the stocks aren't showing the same linear thing. It's just a huge run up right there. Anyway, it's all right. I don't know when it's going to collapse, but it will. As a percentage of total liability. So basically, the mortgage debt fell from 74% to 64%, a percent of total debt. So that means you have 36% as non-mortgage debt, which means that, All right, so here's the amount in total IRAs, assets, total IRA assets. And the IRS is chomping at this like, yeah, this is ratio scale. This is non-ratio. So this would be kind of log. And see how it's just kind of, it's just linear, basically. That's what log does. It makes it linear. But if you look at non-log, you're like, we didn't have any money in 1985, and now we got all this money. Well, it's linear. Linear, kind of. We have from 1980s to 1990, the end of 1990s, flatten off in 2001 and 2, 2002 to 2007, 2008 to here. Look at that. So from a linear perspective or a log perspective, it doesn't look nearly as dramatic as this right here. Look at that. 0.1 trillion, I don't know, was it 100 billion? Is that what that is? 0.1 trillion, something like that? 100 billion? And now we're at, what was that? Freaking $13 trillion. But again, if you do a linear, if you do a log, this is what matters. Now, I just can't stress enough how important that is to understand. Just again, so we got, actually what I want to do, the mortgage debt. Look, right, ratio scale right here. All right, so we got 12, and we'll just say $12 trillion in mortgage debt. We got 14 trillion dollars in IRA assets. So your IRA would wipe out your mortgage debt. Not really, because you got to pay tax on this, but pretty doggone close. Look at that, man. Let's see, number of households, total individual retirement accounts. I can't see this by hundreds of thousands, by thousands. I can't figure that out off the top of my head. But just, man, how can you look at this? And like, I was watching my man, let me show you something else. Chris Martinson, who I like a lot. Let me see if I can't find this. And he was showing how much debt we have. And basically, he's kind of giving some negative stuff. Like, we have too much debt, it's just going to collapse. Debt is only one side of the balance sheet. You got debt and you got assets. You can't just look at debt and say things are bad. You got to look at both sides. You got to look at debt versus assets. Let me see if I can't find that. Hold on a second. There's a total federal public debt, about $30 trillion, which is horrible. I mean, everyone knows that. That sucks. We got a lot of debt. We'll never pay it off. The debt to GDP is over 100%. Oh, my goodness, we're all going to die. Look, I like Chris Martinson. I find that the whole thing, when you look solely at the debt, when you look at solely at the debt without looking at the other side of the balance sheet, you're missing a significant part of the of what's going on. Anyway, so what we can do here, you can say, look at that exploding debt since 1990. Oh my goodness, exploded. Look at that since 2008. Look at that debt, it's exploded. And I remember back here in the 80s, people were saying, Reagan is taking on too much debt. Oh my goodness. And you look at it like that. So look, we have hardly any debt at all, right? And look at that, hardly any debt. Our debt was $653 billion, and now it's $5 trillion, and now it's $30 trillion. Oh my goodness! But let me show you something here. We're going to edit graph, and we're going to log this, and you can see the difference. Pretty flat line there. All right, so we've been taking on debt pretty much the same level, other than right here when Clinton was a president and the Republicans controlled Congress. We flatlined right in there, 2001. Shoops. Look at that. Pretty level linear, which is what a logarithm does, because we got 0 to 2 million. See, I don't know how to do it from 0, but 2 to 4 million is the same percentage as 4 to 8 million. All right, so 2 to 4 million is a 100% increase in debt. 4 to 8 trillion, or trillion I should say, is a 100% increase in debt. 8 to 16 trillion is a 100% increase in debt. 16 to 32 trillion is a 100% increase in debt. And so when you do it in a log, you have the same percentages in terms of the size of the graph. And that's all that matters is percentages, man. What are we increasing percentage-wise Now, I mean, I know it matters dollar-wise, but $1 trillion increase in public debt, if we already got 30 trillion, is a hell of a lot different than $1 trillion increase in public debt if we only have $1 trillion. Hope that makes sense, because that is literally 100% increase in public debt, and now it's not even close. So let's go to non-log here, and you can see we had $1 trillion right there in 1982. And I guarantee you, everybody and their mom were going crazy about the amount of debt we had in 1982 when we broke $1 trillion in public debt. Now we're 30 times that. All right. Well, guess what? We went from 1 trillion to, after Reagan, to 3.5 trillion. We increased our federal debt by 350%. All right. So we went to 3.5 million. So we take our trusty calculator, 3.5 million trillion times 3. Oops. Yeah. Well, there you go. 3.5 trillion times 3. It'd be another. The next 350% would be 12.25. Would be right there. So by 1991 to 2010, basically, we increased our public debt by 350% again. All right, I hope that makes sense. So from 1981 to 1990, we increased our public debt by 350%. From 1991 to, what was it, 2010, we increased our public debt by another 350%. All right, so from 14, we've only increased our public debt by 100% from 2011 to 2021. Now, I'm not saying it's good, but I'm just saying on a linear scale versus logarithmic, you can see it's, or not a log, I forgot what the other one. On a log scale, you see it's not nearly as bad as what people make it seem in terms of the amount of percentage of increase in public debt. And again, the stock market the whole time has gone nuts. Inflation that whole time was basically nothing. I mean, it's 2 to 3%. Wow. But the public debt was going crazy. So how do you explain that? Anyway, there's a lot to be optimistic about, my friends. Don't be following these negative Nellies and stuff. It's just not worth it, man. And I'm not saying Chris Martenson is that. There's a great aspect of fighting the good fight against the COVID stuff. But in this case, I think he's missing a big perspective, which is the asset base. That's huge. That's huge. That's grown significantly more than the debt has. All right, we'll see you guys.